Oh, I think I'm live. Hello. Welcome back to Intentional Money Moves Live. I'm Leah Hadley, and we have a fantastic series that we are sharing with you all over the next several weeks. Let me just open up my chat box here. So you say hello when you join me. If you're watching live, let me know that you're watching. Let me know where you're watching from. It's always nice to know who's here. So we are talking about real money here, real life, real questions. And I encourage people to ask questions along the way. If they have them, pop them into the chat box. Even if you're watching the replay, feel free to put any questions or comments you have, and I will absolutely come back and try to respond and provide additional resources, whatever is most helpful. So as you're joining, be sure to say hello. And again, if you're watching the replay, hashtag replay, let me know that you're watching. So last week, we started a series called Inflation Decoded. And so we're kind of talking through over the next, this is the second episode in the series, and then there'll be three more, 5 kind of pieces of the puzzle, if you will, when we talk about inflation. So last week, very, very straightforward. What is inflation, right? Just basically, what is it? And why does the Fed aim for that 2% rate instead of 0? I think that's important to understand. We talked about why deflation is actually the scenario that really scares economists the most. And if you missed it, I'll be sure to come back and include a link so you can go back and watch it. But today does build directly on top of kind of what we talked about last week. So this is the second episode in the series. Welcome, Poppy. Thank you for watching. And this is the one that I've really been looking forward to sharing with you because we're talking about decoding the headlines. And quite frankly, the headlines create a lot of angst, a lot of conversation. And so I really want to make sure that we really understand and feel confident interpreting the headlines that we're seeing. There's some important ones coming up this week that I'm going to be talking about. So let's just use a simple example, right? If we think about last week's episode, I heard a lot of comments of some type that said, hey, you said inflation is about 3.5%. But boy, does that not feel like that's what I'm seeing in my expenses, right? You may be very correct, right? And that gap between kind of what you're seeing and feeling on a daily basis and what that actual number is in the headlines is really important, right? That number that you see in the headlines, that's going to be an official number. It's an average of a lot of different things, right? When you're looking at the expenses and how it's impacting you personally, that's going to just depend on your own lifestyle, right? The things that you are spending money on a daily, weekly, monthly, annual basis, and how those specific things are changing. So that allows us to get more of kind of a personal inflation rate, if you will, right? So anyway, I pulled 4 very real headlines from the last few weeks. And we're going to be talking about what those look like and what some of the misinterpretations have been of those, and really understanding what are the questions that you want to be asking yourself as you're reading these headlines, so that way you don't react in a way that's just unnecessary and creates additional stress, right? We're going to go through them line by line. We're going to talk about what the words mean, what they don't mean, and if there's some action that it makes sense for you to take based on what you're seeing, okay? So by the end of this episode, you're going to have a 4-question filter that you can run any headline through, and it'll take you maybe a minute or 2, okay? You're actually going to get to use this week. The new, there's somebody right outside my window. The new inflation number is going to be published on Wednesday, I believe, this week at 8:30 Eastern time. So this isn't even theoretical. This is preparing you to fully understand the numbers that you're going to be seeing. So let's get into it. All right, the first headline I want to talk about is one that just came out last Friday. And the headline was, U.S. economy unexpectedly lost 23,000 jobs in July. Okay, now there's 4 things in that sentence, and 3 of them are probably doing something that you may not have even noticed, okay? So let's start with lost 23,000 jobs, okay? That is a net number, Okay. It doesn't mean that 23,000 people got fired, right? Every single month, millions of people are getting hired and millions of people are losing their jobs, right? The number that you see in the headlines is going to be the difference between those very, very like enormous flows, right? So 23,000 against 160 million jobs is actually like a rounding error, right? When we actually look at the numbers. So what matters is the direction, okay? And that's what's really important. Now, the word unexpectedly, okay, let's talk about that. That word is really carrying most of the weight in this headline. So the economists that were surveyed before the report had forecast a gain of something in the range of 83,000 to 95,000 jobs, right? So the real story isn't that we lost 23,000 jobs. The real story is that we came in about 100,000 jobs below what the economists had expected, okay? So every time you see unexpectedly or you see surprise or shock in a financial headline, what you're being told is that the reality and a forecast did not agree, okay? That's it. It's not the same thing as a catastrophe, and that's really important to know, right? And here's the part that actually didn't make the headline at all. In that same report, the unemployment rate went down. It ticked down to 4.1%. So just take a minute with that, right? We lost jobs, but unemployment improved. How is that possible? Well, here's what's really important to understand, okay? Unemployment only counts people who are actively looking for work. So if you stop looking, then you're no longer part of that count, okay? And if you're not unemployed anymore, in the statistical sense, right, you're just not there. So the rate can improve, absolutely, because more people found jobs, or the rate can improve because fewer people are trying, right? In July, a good chunk of it was actually the second. Those two situations look identical on a chart, but in real life, they can feel very different, right? And then there's the number that I would actually circle, which nobody put in a headline anywhere. And that is that average hourly earnings increased 3.2% over the past year. So we talked about last week that inflation has been running at about 3.5%. So if average hourly earnings increased 3.2%, while inflation is running at about 3.5%, wages are growing slower than prices, right? That's actually the most relevant number in the entire report for most households, and it's buried in the report. So that's the pattern I really want you to start seeing. The headline number is almost never the number that actually touches your life. It's actually going to have an impact on you personally. So if you've had that experience where maybe you got a raise and somehow nothing felt easier, you're not alone, right? If you got a raise and nothing felt easier because expenses are going up higher than what your actual raise is, that's hard, right? And so we're going to spend some real time talking about specifically how do we understand this from a financial planning perspective in the last session of the series. So we're going to build up to that. But let's take a look at another headline. So we talked about the headline from last Friday, the jobs report. Let's talk about a headline that came out on July 29th. Okay. And that headline said that the divided Fed holds interest rates steady. So holds interest rates steady. What does that mean? The federal funds rate stays where it's at. So 3.5 to 3.75%. That's the bank's rate that they charge each other, right? And it sounds impossibly far from most people's life, but almost everything else actually prices itself off of that. So your mortgage rate, your car loan, credit card APR, the yield on your savings account, when that rate moves, those rates are eventually going to move as well. And divided, right? We said Fed divided means that the vote was not unanimous. It was 9-3. So there were 3 officials that dissented. And here is the part that almost everyone reads backwards, including plenty of people who cover this for a living. When you see divided Fed, the natural assumption is that the dissenters wanted to cut rates, that someone was pushing for cheaper borrowing and got outvoted. And that's not what happened here, okay? So all three dissenters wanted to raise the rates by 1/4 point. Their argument is that inflation is now above that 2% target, and it has been for over 5 years, and simply holding steady just isn't bringing that rate down fast enough. So flip your kind of read of that headline entirely, if you will, right? The disagreement inside the Fed right now is not between holding and cutting, it's between holding and hiking. So why that matters for you practically, it tells you the direction of the risk, right? If you've been sitting on a decision, so maybe you're waiting for rates to come down before you refinance, or before you take out a new car loan, or before you take on any borrowing, this headline is telling you that the people who actually set the rate are not currently arguing about when to cut, right? That doesn't mean to rush, but it does mean that we don't want to build a plan on the assumption that the rates are going down, right? Now, the next Fed meeting is the middle of September. So when you see coverage of it, now you know what to look for, not just what they did, but who disagreed and in what direction, right? The dissent is really the story, if you will, okay? And if you've been waiting on rates for something specific, share in the comments. We would love to hear about it. And, you know, it's frustrating when you're sitting in a holding pattern, right? And so I'm sure there are other people who can like kind of resonate with what you're experiencing. All right. The third headline that I want to talk about is the one from the June inflation report that was released July 14th. And that headline said, inflation falls to 3.5% below forecast. Now, again, I think this is honestly one of the single most misread sentences in all of financial news. So I want to slow way down here because this is the one I promised you last week, okay? Inflation falls to 3.5%. What's confusing about that is the word falls, all right? Inflation falls 3.5% to 3.5% does not mean that prices fell, okay? It means that prices are still going up. They're just going up 3.5%, right? Instead of whatever the number was the month before. So inflation falling means the rate at which the prices are going up has fallen, right? The prices themselves are still going up. And everything that already got more expensive, it's still, I mean, we're not talking about things going down, right? If you think about driving, you're going 70 and you ease off to 60, you slow down, but you're still driving, right? And you're still getting further and further from where you started. Slowing down is not the same as reversing. So that's the entire reason a news anchor can say inflation is cooling during the same week that you're like, oh my gosh, the grocery bill just keeps going up, right? Both things can be true. And they're describing two completely different things, right? And so I know that there can be a lot of confusion around this issue. It comes up all the time. If you have questions about it, feel free, if you feel comfortable, putting it in the chat. If you're watching the replay, again, I'm happy to come back and respond to any of those questions or comments. All right, now the second half of that headline was below forecast, right? Below forecast means the number came in lower than what economists had predicted. Now that's it. It tells you nothing about whether the number is good or bad, right? Watch how this works. A 3.5% reading against a forecast of 3.7% gets written up as encouraging news, right? Cooling, better than expected. That same 3.5% reading against a forecast of 3.3% gets written up as hot, sticky, worse than feared, right? Same reality, opposite headline. The only thing that changed was that a group of forecasters guessed what a group of forecasters had guessed the week before. Markets do trade on that surprise. You've heard me say it over and over, if you followed me at all, that markets, short-term market fluctuations are constantly responding to headlines. Long-term market is driven by corporate valuations, right? But markets trade the surprise, right? You live in a level. Those are not the same job. And financial media is mostly written for the first one, right? In order to create the shock value, if you will, right? Now, the third thing in that report worth knowing, that same release had core inflation at 2.6%, while the headline number was 3.5%. So what's the difference, right? Core inflation does strip out food and energy. So economists watch it because food and gas prices do tend to swing a little bit more for a lot more reasons, right, than just kind of what the broader economy is doing. So taking them out does give us just a cleaner read on what the underlying trend is. And that's a reasonable thing, quite frankly, to do. So it is important, to have an idea of where the economy is. That said, you don't get to strip out food and energy from your life, right? So when we're thinking about how do these things impact our lives, I don't know that core inflation number really gets to what most individuals are experiencing. All right, so when you hear two different inflation numbers in the same news segment, right, and you're wondering, hey, which one's real? It's not necessarily that one is real and one is fake, right? They're answering two different questions, and it's important to understand that. Hi, Jennifer. Thanks for being here. And last piece on this particular headline, why did June actually come down? And it was energy, right? That report showed the largest 1 month drop in the overall index since April of 2020, and falling energy prices were the main driver. So inflation falls, right, that we saw, that mostly translated into gas prices. So if you commute an hour each way, you may have felt that relief, right? That may have had a big impact. If you work from home, you barely drive, you probably didn't feel anything, right? That's the gap. And now you can see the mechanics of it, right? The CPI is that blended average across a giant basket. And your life just isn't that same blended average, okay? So when the headline and your experience just don't agree, the headline isn't lying, right? You're not being dramatic. You're looking at two different things, right? So if you have ever experienced any confusion around this, I want to be very clear that you're not alone. And that's why we're having this conversation, right? So if you have any questions, put them in the chat. All right, last headline we're going to talk about. This one showed up right after, Friday's jobs report. And I'll tell you what, this one took me by surprise. I really had to take some time with this one. And that was economist warns a third of the country is already in or near a recession. Okay. Now let's decode this, right? First things first, economist, singular, warns, right? That means that one person, right? If we're saying there's an economist that's making this warning, we're talking about one person. In this particular case, we were talking about Mark from Moody's Analytics, who is a well-respected individual, certainly worth listening to. Also, one person's opinion, right? Also, it is an estimate, not an announcement, okay? Recessions in the US are formally dated by a committee at the National Bureau of Economic Research, and they typically make the call long after the fact. Sometimes it's a whole year later, okay? So I want to be clear that this isn't a siren, right? It's not, there's nobody who's going to be out there calling your house and be like, oh my goodness, this is what's happening, right? By the time it's been officially a recession, typically we've already lived through the worst of it, okay? The second thing is a third of the country, okay? Let's talk about what this means, a third of the country. That is a regional and sector level claim, not a national one, okay? Some parts of the economy can absolutely be contracting while the numbers could still remain okay? And that's really important to understand. And it's also very different from the country as a whole is in the recession, right? That's very different. The third thing that I want to point to is that 2 consecutive quarters of negative GDP growth or decline, I guess, decline in the GDP. You've probably heard your whole life that that's the rule of thumb in determining whether or not we're in a recession, right? That actual determination takes into a lot more, right? It looks at income, employment, spending, production, all together. All right. So what do you do with this recession headline? Honestly, mostly nothing. But here's what I want you to do with it. I want you to notice the emotional pull that the word has. And then I want you to separate it from the pull, from the question of whether anything in your actual plan needs to change as a result, right? For most households hearing this, the honest answer is no. Okay. Now, there is an exception that's worth naming. Okay. A recession headline is a perfectly reasonable prompt to go look at two things. Okay. How many months of expenses have I set aside? Do I have that solid emergency fund? And I know some of you who have had this conversation with me recently know that I'm going to say this. How secure is your income? How secure does your income feel right now? Not to panic, just want you to have a good, solid understanding, okay? That's when we talk about the intentional money method, we talk about the clarity pillar and how important it is to have clarity around your financial situation, clarity without judgment, clarity without shame, right? Knowing where your income's coming from, knowing what your expenses are that you've committed to, understanding your assets, what you own, knowing what your liabilities are, what you owe, right? All right. So we walked through 4 headlines. Now, here's the thing that I really want you to walk away with. And if you did not see today's, we have like a handout that goes with these inflation sessions. I will include the link that you can use to opt into that handout if you didn't get it. But if you're signed up, if you're on our email list, you're getting notifications about these sessions, there was actually a link in it. So these 4 questions, you don't have to like scramble to write notes. These 4 questions are all in that handout. And so like I said, I'll include the link as soon as I'm done to get a copy of the download if you need that. But if you're on our email list, we did send it out with the notification about this session. So here's the 4 questions, all right? I want you to run any headline, any financial headline that you see through these, and that's just going to eliminate the noise that may be pulling you in, okay? So question number 1, is this a level or a change, okay? So inflation is 3.5%. That statement is a level. Inflation fell, that's a change, okay? So headlines blend these things together constantly, and confusing the two is precisely how most people end up believing that prices went down when quite frankly they haven't, right? So question number 1, is it a level or is it a change, okay? Question number 2, I want you to ask yourself, what are we comparing this to, okay? Last month, last year, are we comparing to what forecasters guessed? Below forecast, lower than a year ago. Those are very different claims, okay? And only one of them has anything to do with your life. So I want to be clear, what are we comparing this number to, right? 3rd question, whose average is it? Now, if you've been following me for a while, you probably know that I really enjoyed statistics. When I was in college, I was the TA for statistics class. I ran the data lab for statistics. My degree is in sociology, and I really, really enjoy quantitative analysis, which probably won't surprise many of you, right? But I love talking about some of this terminology because I think it's really, really important. I think numbers can tell a really interesting story, but what's the receiving end of that story, right? Like, are we really understanding what that story is? So whose average is it? A national blended number, that's an example that might be averaged, right? A particular sector, you may be talking about an average for a specific industry or sector, right? It may be a group of economist estimates. It may be one economist estimate, right? There is so much financial anxiety that comes from taking a national average and assuming it personally that is just unnecessary. So I want to make sure you understand, if you're looking at these numbers, we're being very clear about what are we averaging here? What are we really looking at, right? And then the last one, and I promise I'm wrapping things up here. The last one is, does this ask anything of me today? Now we're going to go much more detailed into this specific question in the 5th segment of this series. But it's important. Most headlines, just information, not instructions, right? Very, very, very few headlines actually require a decision in the week where that headline came out, right? The ones that do usually involve a rate you're about to lock in or a large purchase you're about to make, okay? So the 4 questions that you're asking yourself, level or change, compared to what, whose average, and is it asking anything of me? Is there anything that I need to take? That's it, okay? And you get to practice this As a reminder, on Wednesday at 8:30 Eastern time, we should see the July inflation report come out. So this is what I want you to try. And again, if you haven't opted into that handout, so if you need a refresher on the 4 questions, make sure I'll include a link as soon as I'm done so we can get those handouts out to you guys. If you're on our email list, it's in your email already. Download it, access it, reference it. As soon as you start to make this a habit, it becomes very, very easy. But I think it's helpful to have those questions in front of you as you are working toward creating that particular habit. So next Monday, we're going to be in episode 3. We're going to talk about the sneaky ways that inflation shows up, such as shrinkflation, right? Where price holds steady, but the box gets quietly smaller. We're going to talk about skimpflation, where the price holds, the quality drops. And what's actually happening to your paycheck once you account for rising prices, right? We talk about what we talked about earlier with that wage growth of 3.2 versus the CPI at 3.5. So you're going to really leave that one able to really witness this in your life and know where you see it. The 4th session, we are talking about who inflation helps and who it hurts because it is not distributed evenly. Debt and savings behave very differently when prices are rising. And once you see which side you're on, you can position yourself instead of maybe just kind of absorbing whatever's happening, right? And then the last week, this is where we really tie it all in a bow. We're going to turn all of this into an actual action plan, including what do you do when your income just is not keeping up with inflation? So if you walk away with one thing for today, here's what I want you to walk away with. Financial headlines are written to be understood in like 3 seconds, right? Your financial life does not operate on the same timeline, okay? Almost all money anxiety lives in the gap between those 2 speeds, okay? You do not have to be an economist to close the gap, right? Take those 4 questions. Give yourself time to truly understand the headlines. Is it a level or a change? What are we comparing it to? If we're talking averages, what are we averaging? And last but not least, is this asking anything of me today? Okay. So again, take advantage, download the handout that goes with this. And if today brought up some questions for you, right? These are the kinds of conversations we have in our Empowered Sisterhood membership program. That's where we're really breaking down the barriers around talking about money and building financial confidence in a truly meaningful way. So if that is of interest to you, want to learn more about that, feel free to send me a direct message. I respond to all of them, so I would love to hear from you and answer any questions you may have about that program. Thank you so much for joining us for Intentional Money Moves Live today, and I look forward to seeing you next